What if you could invest like a venture capitalist? I'm not in the sense of having access to private companies before they go public, although that is part of what some venture capitalists do, but I mean in the sense of the underlying logic, like the framework they use to think about deploying capital into high uncertainty situations where a small number of bets will return extraordinary multiples, and those extraordinary returns drive the performance of the entire portfolio. Most individual investors never think this way. They apply the same logic to every investment. Research the company, assess the prospects, decide if it looks like a good bet, and size the position based on conviction. If they're confident, they put in more, and if they're uncertain, they put in less. They are trying to be right about each individual investment, and they size accordingly. But venture capitalists operate from a completely different set of assumptions. They think in terms of a portfolio and an expected distribution of outcomes across it. Now, across a portfolio of say, 20 positions, they anticipate that one or two will go to the moon, producing returns of 10 times, maybe even 50 times or more. And one or two will disappoint significantly, losing most or all of the invested capital. And the rest, the majority, will deliver outcomes ranging from not very good to pretty good. Some might double or even triple, but some will produce solid, unspectacular returns. The venture capitalist is not surprised by any of this. They plan for it. The entire model is designed around that distribution. Now, what makes this model so powerful is asymmetry. The one or two positions that go to the moon are not bounded in how far they can go. A position that returns 50 times contributes 50 units of return for every 1 unit that it cost. The positions that disappoint contribute a loss of at most 1 unit. You can only lose what you put in. And that mathematical imbalance is the engine. The moonshots don't just cover the losses. In a well-constructed portfolio, they more than compensate for everything, the failures and the middling performers alike. And they still deliver overall returns that are genuinely impressive. The structure of the payoffs does the heavy lifting, not the win rate. Now, the individual investor does not generally have access to pre-IPO equity in the way that institutional venture capitalists do. But the logic, the portfolio thinking, the asymmetry, the acceptance of losses as the price of participating in outsized gains, all of that applies to a much wider range of investable assets than most people realize. Things like emerging technology sectors, or cryptocurrency ecosystems, or early stage public companies in industries that are undergoing structural transformation. Maybe even commodities tied to long duration demand shifts, or biotech firms with binary outcome potential. These are not private equity investments, but they carry similar return profiles. Limited downside per dollar invested, but potentially enormous upside if the thesis is correct. Now, the accumulation engine applies venture capital thinking to these kinds of publicly accessible opportunities. It's the third engine in the three-engine wealth system, and its mandate is different from the other two. The income engine generates reliable cash flow. The growth engine compounds capital systematically and dramatically outperforms the market over time. But the accumulation engine pursues something different. Asymmetric, long-horizon returns that can produce the kind of wealth multiplication that neither of the other two engines is designed for. In the next few episodes, when we show you how all three engines work together, you'll see why the accumulation engine is the third engine and not the first, and why you need the income engine and the growth engine running well before you allocate meaningful capital to asymmetric bets. But first, let's understand what the accumulation engine actually is and how it operates. So let's look at what counts as an asymmetric opportunity. The accumulation engine is thesis-driven. That is the first and most important characteristic. You're not buying something because it's gone up, or because someone recommended it, or because it's currently attracting a lot of attention. You're buying it because you have a specific, articulable thesis about why it could be worth dramatically more in 3 or 5 or 10 years, and you're prepared to hold it through significant volatility while that thesis either plays out or doesn't. Now, a thesis is not a prediction. It does not say that the price will be at a certain level by a certain date. What it says is, if these specific things happen in the world, if this technology reaches adoption at scale, or if this regulatory environment shifts in this direction, or if this structural demand trend continues, then this asset should be worth substantially more than it is today. The thesis gives you something to evaluate over time, not the price, but the underlying conditions the thesis depends on. And this distinction matters enormously for how you manage the accumulation engine. If you're holding because of a thesis, then a price drop is only a reason to reconsider if the thesis has changed. If the conditions the thesis depends on are still developing, if the technology is still advancing, or the regulatory shift is still underway, or the demand trend is still intact, then the lower price is potentially an opportunity to add, not a reason to exit. So you're not managing the price. You're managing the thesis. Now, what kinds of opportunities qualify here? Well, the defining characteristics are these. First, the potential upside must be genuinely large, not 15 or 20%, which the growth engine can deliver systematically. We're talking about the potential for 5 times or 10 times or even more on the invested capital if the thesis proves correct. Second, the thesis must be tied to a durable, multi-year trend, not a quarterly earnings cycle or a short-term sentiment shift, but something structural that plays out over years. And third, the downside must be limited to the amount invested. You're not taking on leverage or unlimited liability in the accumulation engine. What does this look like in practice? Well, that depends entirely on you, on your research, your convictions, and the mentors and analysts that you choose to work with through the virtual investing organization. For some investors, the accumulation engine is built around major technology trends. Artificial intelligence infrastructure, for example, or the energy transition, or semiconductor supply chains. And for others, it might be cryptocurrency ecosystems, like I mentioned earlier, or where the potential for protocol-level adoption could produce extraordinary returns in a decade. For others still, it might be emerging market real estate, or commodities that are tied to electrification, or early-stage public companies in a sector that's undergoing a structural disruption. The specific opportunities you pursue in the accumulation engine are your choices, and they're guided by the analysts and researchers that you engage through your virtual investing organization. What we can provide through the $1 Million Experiment is a transparent account of the specific theses that we have chosen to pursue and why we chose them and how they're performing, not as a recommendation, but as a live case study in applying this framework to real markets. Now, what the accumulation engine is not is a trading account. It is not where you put money that you might need in the next 2 years. And it's not where you make impulsive bets on things that are currently exciting. And it's absolutely not where you concentrate a large portion of your capital in a single position, regardless of conviction. The venture capital model works because of diversification across many asymmetric bets, not because of concentration in the ones that you feel best about. And let's talk a little bit about the selection process, because this is where the virtual investing organization becomes essential. Building a credible accumulation engine requires access to good research. People who understand specific sectors or asset classes deeply enough to construct a thesis that holds up to scrutiny. Then you're not going to develop that depth of expertise yourself across every category that the accumulation engine might invest in. What you can do, though, is identify the researchers, the analysts, the macro thinkers whose work you find compelling and whose track record of thesis construction is sound, and whose areas of focus align with the kind of asymmetric opportunities you want to pursue. They become the accumulation engine team of your virtual investing organization. Their research informs your thesis construction, and your judgment determines which theses you act on and how you size them. The decision is yours. The research infrastructure behind it is assembled, not invented from scratch. Now let's look at how the accumulation engine is funded and sized. The accumulation engine is the third engine in the funding sequence, and that sequence is deliberate. It's not funded directly from your salary, and it's not funded from the income engine's monthly cash flow. It's funded from a portion of the growth engine's returns, which means it only receives capital after the income engine is running and the growth engine has begun compounding. This is a structural feature of the system, by the way, not an arbitrary rule. And the reason is straightforward. The accumulation engine carries the highest risk of the three engines. Individual positions can and will go to zero. The portfolio as a whole should produce strong aggregate returns over time if the thesis selection is sound, but there is genuine uncertainty in a way that the income engine and growth engine don't have, at least not to the same degree. Funding the highest risk engine last from the returns generated by the lower risk engines means the system's foundation is never compromised by accumulation engine losses. This is one of the most important structural principles in the three-engine wealth system. The accumulation engine should be sized so that even if every position in it went to zero tomorrow, the income engine and the growth engine would continue operating without any material impact. The accumulation engine is the bonus layer of the system. It's where you give yourself the opportunity for extraordinary wealth multiplication, but it is not the foundation. Treating it as the foundation is one of the most common and most costly mistakes individual investors can make when they encounter an exciting asymmetric opportunity. Position sizing within the accumulation engine follows the same venture capital logic that we talked about earlier. Consistent dollar amounts per position, regardless of conviction level. This is counterintuitive for most investors. Like if you're very excited about one opportunity and only moderately interested in another, the instinct is to put more into the exciting one. The venture capital market model argues against this for a very specific reason. Your conviction and the actual outcome are not reliably correlated. The investments you're most excited about are not systematically the ones that return the most. Confidence is not an edge. The portfolio structure is the edge. By sizing positions consistently, putting the same dollar amount into each opportunity, regardless of how strongly you feel about it, you ensure that your portfolio's performance reflects the quality of your thesis selection across the whole portfolio, not the quality of your conviction on any individual bet. If one position returns 20 times and you had sized it the same as everything else, you still capture that return. And if a position you were highly confident about goes to zero, it takes the same bite out of the portfolio as any other zero. In the $1 million experiment, the accumulation engine is funded from growth engine returns once the growth engine reaches sufficient scale. Our baseline aggregate return expectation is 20 to 30% annually, reflecting the expected distribution of moonshots, decent to good middle performers, and the occasional disappointment. If the moonshots materialize at the high end of what they can produce, the actual return will be higher. But 20 to 30% is the floor that we plan to, not a promise and not a ceiling. Your own baseline may differ depending on the opportunities you pursue. What doesn't change is the structure. Consistent sizing, thesis-driven selection, annual review cadence, and a portfolio that's broad enough that no single position determines the overall result. Now, there's one more thing I want to say about the bonus layer framing. Calling the accumulation engine the bonus layer is not a way of saying that it's unimportant. It's a statement about sequencing and risk management. The accumulation engine has real potential to add meaningful returns on top of what the income and growth engines produce. And if the moonshots materialize, those returns can be substantial. Now, the actual magnitude depends on allocation size, which theses prove correct, and how far the winners run. And we won't put a ceiling on that upside. But what we will say is that it should be additive, built on top of a system that's already working and not a substitute for one. Now let's look at managing the accumulation engine over time. The accumulation engine is managed differently from the other two engines, and understanding that difference is important. The income engine is reviewed monthly. It has a monthly cash flow target, and it has a monthly performance scorecard. The growth engine is reviewed at least quarterly, with close attention being paid to how individual positions are performing and how new capital is being deployed. But the accumulation engine is reviewed annually. And it's not because it doesn't matter. Of course it does. It matters enormously. But it's because the time horizon of the thesis demands it. Reviewing an accumulation engine position monthly is like checking to see whether a tree you planted last week has grown. I mean, the signal to noise ratio is terrible. Short-term price movements in asymmetric, long horizon assets are almost entirely noise. They're driven by sentiment, liquidity events, macro conditions, and the general mood of the market, rather than by the underlying thesis that you invested in. So checking the price every month and reacting to what you see is one of the most reliable ways to destroy the returns that patient, thesis-driven holding would otherwise produce. The annual review asks a specific set of questions. Has the thesis changed? Are the conditions of the investment that the investment depends on still developing as expected? Or are they stalled? Or are they moving in the wrong direction? Has anything emerged that fundamentally undermines the original reasoning? If the thesis is intact, then the position stays. If the thesis has changed materially, well, then you evaluate whether to exit, reduce, or hold, depending on the specifics. The price is relevant as context, but it does not drive the decision. The thesis does. Now, two specific management rules deserve particular attention. The first one is no panic selling on drawdowns. Asymmetric positions will, with almost certainty, experience significant drawdowns at some point. 50%, 70%, sometimes more. This is not evidence that the thesis is wrong. It's the nature of long horizon, high volatility assets. The appropriate response to a large drawdown is to return to the thesis. Is it still intact? If it is, then the drawdown is either irrelevant or it's an opportunity to add at a lower price. If the thesis is genuinely broken, exit regardless of the drawdown. But the drawdown itself is not the signal. The thesis status is the signal. The second rule concerns winners, and it's the opposite of what conventional portfolio management might tell you. In the venture capital model, winners are protected and potentially added to. They're not trimmed back to restore some notional portfolio balance. The whole game is identifying the positions that are working. When one starts to significantly outperform, you hold it, revisit the thesis, and ask whether the underlying conditions have strengthened. If they have, you might selectively add. And if they're still intact but not yet fully played out, well, then you hold. But what you don't do is sell a winner simply because it now represents a larger percentage of the portfolio. Now, the flip side of protecting winners is to not reinforce losers. If a position has declined significantly and the underlying thesis is genuinely broken, not just under pressure, but fundamentally invalidated, then accept the loss and move on. You do not average down into a broken thesis. You do not hold indefinitely out of stubbornness either. You evaluate the thesis honestly and act on that, not on the price. There's a practical discipline that makes both of these rules easier to execute. Keep a written record of every accumulation engine position. The thesis as you understood it at entry, the specific conditions it depends on, and why you sized it the way you did. And review that record annually. This forces you to evaluate each position on the thesis merits rather than on how the price has moved. A position that has gone up significantly might still have years of thesis left to run, or it might have already priced in most of what you expected. A position that has fallen might be a buying opportunity if the thesis is intact, or it might be telling you the thesis was wrong. The written record is what lets you make that distinction honestly. Now, let me bring together what we've covered in this episode. The accumulation engine applies venture capital logic to publicly accessible asymmetric opportunities. Its mandate is different from the other two engines. It's not reliable income and it's not systematic compounding. It is the pursuit of large, long horizon returns that can produce genuine wealth multiplication on a carefully sized portion of your capital. It's thesis-driven. You invest because you have a specific, articulable case for why an asset could be worth dramatically more over a multi-year period. And you hold based on whether that thesis remains intact, not based on the price. It's consistently sized. The same dollar amount goes into each position regardless of conviction level, because the portfolio structure is the edge, not your confidence in any individual bet. It's funded last, from growth engine returns, after the income engine and growth engine are running. This ensures that the accumulation engine losses, which will happen, never compromise the foundation of the system. And it's managed annually, not monthly. Short-term price movements are noise. The annual review asks whether the thesis is intact. That answer drives decisions, not the current price. Now, with this episode, we've introduced all three engines of the three-engine wealth system. The income engine generates monthly cash flow through active market participation using whatever approach fits your situation, your schedule, and the mentors you choose. The growth engine compounds that capital into a growing base that dramatically outperforms passive market returns over time through a systematic method that welcomes down markets as opportunities to add, potentially, rather than setbacks. And the accumulation engine pursues asymmetric, long horizon returns on a sized allocation that adds meaningful upside potential without putting the foundation at risk. In our next episode, we're going to take a step back from the individual engines and look at the system as a whole, how the three engines connect, how capital flows between them, how they interact during different market conditions, and why the system produces results that none of the other engines could produce alone. That episode is where the full power of the framework becomes clear. Now, the complete 5-year plan for the $1 million experiment, including the projected trajectories for all three engines, is available as a free download at theinvestingproject.com. The link is shown on the screen. It's in the notes, the comments. Please feel free to check it out. And remember to subscribe so that you don't miss the next episode, and we'll see you then.